Assalamualaikum and salam sejahtera. Today, my friends Nur Farah Syafiqah, Nur Atira, Nuriza Aida Julia, Nur Naziha, Siti Noraini and I, Nur Faika, will be presenting about economic feasibility. Definition of economic feasibility. It is a process of identifying the financial benefits and costs associated with a development project. Basically, it helps to determine the viability, costs, and benefits associated with a project, and it serves an independent and helps in decision making.
Tangible benefits. It's referred to items that can be accurately measured. Tangible benefits also defined as a refer to items that can be measured in dollars and with certainty to the organization through the use of the information system. For example of tangible benefits is reduced personnel expenses, higher profit margins, and lower transaction costs. Most tangible benefits will fit within the following categories. There are 6 tangible benefit categories, which are: first, cost reduction and avoidance; second, error reduction; third, increased flexibility; fourth, increased speed of activity; fifth, improvement of management planning and control; and the last one, opening new markets and increasing sales opportunities.
Alright, now we continue with determining project benefits under intangible benefits. So secara ringkasnya, intangible benefits adalah manfaat yang tak boleh dikira melalui nilai duit. Now, let's jump to the definition of intangible benefits. So, it is a benefits derived from the creation of an information system that cannot be easily measured in dollars or with certainty. And it may comes in two ways, which is may have direct organizational benefits, such as the improvement of employee morale, and second, may have broader societal implications, such as the reduction of waste creation or resource consumption. So this is the example of intangible benefits, such as competitive necessity, more timely information, increased organizational flexibility. So ni adalah antara manfaatnya lah, antaranya kalau dari segi social, positive impacts on society, improve social responsibility, better usage of resources, yang ni untuk alam sekitar, dan yang lain boleh baca sendirilah.
Next, I will explain about the tangible cost. Tangible cost is a cost associated with an information system that can be measured in dollars and with certainty. Besides, tangible costs are those that can be accurately projected by the system analyst and the business accounting personnel. Information system development tangible costs include cost of equipment such as hardware costs, cost of resources, for example labor costs, and the last one, operational costs such as employee training and building renovation.
Alright, next we continue with determining project costs under intangible costs. So the definition of intangible cost is a cost associated with an information system that cannot be easily measured in terms of dollars or with certainty. So kalau tadi kita bincang pasal benefits, yang ni kita cerita pasal cost, which is kerugian, iaitu kerugian yang tak boleh dikira dengan nilai duit. Alright, this is the example of intangible costs, which can include loss of customer goodwill, employee morale decrease or operational inefficiency, losing a competitive edge, losing the reputation of being first, declining company image, and ineffective decision making. So ini adalah antara kerugian yang tidak boleh dikira dengan nilai duit. Antaranya adalah motivasi dan moral pekerja menurun, image company pun menurun, hubungan dengan customer pun makin rosak, makin merudum dan sebagainya.
Now we move on to one-time cost. So It is a cost associated with project startup and development or system startup. One-time cost specifically designated on the company's financial statements as an extraordinary or one-time expense that the company does not expect to continue over time, at least not on a regular basis. So basically, this cost encompass activities such as system development, new hardware and software purchases, user training, site preparation, data or system conversion. But only some costs are one-time costs. Other than that, can be a recurring cost.
Recurring costs refer to costs resulting from the ongoing evolution and use of the system. For example, application software maintenance, incremental data storage expenses, incremental communications, new software and hardware licenses, supplies and other expenses, example paper, forms, data center personnel. Both one-time and recurring costs can consist of items that fixed or variable in nature.
Fixed costs are costs that are billed or incurred at a regular interval and usually at a fixed rate. Fixed costs do not change. It is constant no matter how much or little the system is used. The costs are not dependent upon the operation of the system. So, the example of fixed costs are property tax, lease payment that must be paid monthly, insurance and depreciation of fixed assets. Variable costs are occur in proportion to the usage of the system. Variable costs are also incurred on regular basis. They are proportional to the work volume and continue as long as system is in operation. Variable costs tend to be more diverse than fixed costs. So example of variable costs are long distance phone charge, wage costs, supplies costs, and some maintenance costs.
Guidelines for better cost estimating. First, have clear guidelines for creating estimates. Second, use experienced developers or project managers for making estimates. Third, develop a culture where all the participants are responsible for defining accurate estimates. Fourth, use historical data to help in establishing better estimates of costs, risks, schedule, and resources. Next, update estimate as the project progresses. And the last one, monitor progress and record discrepancy to improve future estimate.
Last but not least, let's moving on to the time value of money. Time value of money, TVM. It is a concept that money available today is worth more than the same amount tomorrow. Let's look on the formula on how to calculate time value of money. We'll be using discount rate, present value, net present value and PV, return on investment ROI, and break-even analysis BEA. Discount rate is the rate of return used to compute the present value of future cash flows. Present value is the current value of a future cash flow. Net present value and PV use discount rate to determine present value of cash outlays and receipts. Return on investment ROI is a ratio of cash receipts to cash outlays. And lastly, break-even analysis BEA is amount of time for cumulative cash flow to equal initial and ongoing.
Net present value is a prediction of how much your money will be worth in the future based on an expected discount or depreciation rate over time. So basically, the concept of present value states that an amount of money or cash in the present day is worth more than receiving the amount in the future, since today's money could be invested and earn income. So the formula above calculates time value of money. So PVN equals to present value of Y dollars and years from now based on a discount rate of I, and PV equals to sum of PVs across years. Break-even analysis is a type of cost-benefit analysis to identify at what point, if ever, benefits will equals to cost. At the slide, there is a formula of break-even ratio which equals to yearly NPV cash flow minus with overall NPV cash flow divided by yearly NPV cash flow. So break-even ratio tells you the percentage of time into the project that the benefit starts to exceed the cost. Normally, earlier in the process, expenses will outweigh the benefits, but eventually, benefits will caught up with the cost. On a side note, overall cash flow is the total cash flows of that particular year and the preceding years. But yearly cash flows equals to the cash flows on that particular year only.